Following on part 1, where we explored the history of cryptography leading up to Satoshi Nakamoto's groundbreaking creation of blockchain and Bitcoin, we are now going to dig into the history of our monetary system. And to give each topic the attention it deserves, I have split it into part 2 and 3. In this video, we will start from the post-war era and the creation of Bretton Woods Agreement, leading up to the decoupling of the dollar from the gold standard. We will also cover key economic events in the 70s right up to the end of Alan Greenspan's tenure as Fed chairman. This marks the beginning of the fiat currency, backed only by the trust in the government. Although we will focus on the US due to its role as the global reserve currency, similar events have occurred in central banks and economies worldwide. In the next video, we will look at how recent events and growing concerns over high debt, monetary policies, and economic instability and inequality have affected people's faith in the traditional financial institutions and government-backed currencies, and with some even calling to go back to the gold standards. This loss in trust has motivated a search for alternatives, paving the way for decentralized money like Bitcoin. There's lots to unpack, so let's get started. Our story begins with both the intended and unintended consequences of the aftermath of World War II.
World War II devastated nearly every major economy, except the United States. It emerged as the global financial superpower. The dollar had become the world's most stable and trusted currency. Other countries pegged their currency to the dollar, which could still be redeemed for gold.
The world retooled its entire global infrastructure and became globalized into a rules-based order, starting with the 1944 Bretton Woods Agreement, which tied all currencies together. This was followed by the establishment of the UN in 1946, the General Agreement on Tariffs and Trade in 1947, NATO in 1949, and the EU in 1957. The Bretton Woods Conference, officially titled the United Nations Monetary and Financial Conference, involved 730 delegates from 44 allied nations in Bretton Woods, New Hampshire, US, to regulate the international monetary system post-World War II. It created a system where the US dollar, which was convertible into gold, became the global reserve currency and set the standard for other currencies in relation to it.
This meant that countries around the world could trade their currencies for US dollars, which they could then exchange for gold. This created a system where all currencies were essentially backed by gold. To avoid the logistics of shipping physical gold across the world, when countries did exchange their currencies for gold, it was usually stored safely in the US.
Following the euphoric years after World War II, the world experienced the largest population boom ever seen, with global population growing by 30% in just 20 years. At the same time, every economy was stimulated with government fiscal spending in an unprecedented manner. This, combined with the Marshall Plan, a US-sponsored program designed to rehabilitate the economies of 17 European countries, created the economic boom of the 1950s and 60s. Standards of living rose as technology previously used for warfare was repurposed for consumer goods production. America emerged as the dominant superpower with a rules-based global architect built around its globalized ambition. After World War II, the US experienced a significant drain on its gold reserves due to increased imports and financial aid to war-torn nations. The competitive rise of foreign economies, along with mounting costs from social welfare programs and the Vietnam War, further strained America's balance of payments, and they started running the budget deficits. This economic pressure led to the collapse of the gold pool in 1968, as member nations hesitated to maintain the set market price of gold.
With all the new spending programs in the United States, other countries became concerned that the US was spending more money than it had gold reserves. They started exchanging their dollars for gold and demanded physical delivery, as they felt that there were more dollars being printed than the gold that backed it. To prevent this outflow of gold from American vaults, President Nixon called for an emergency suspension of the gold convertibility system.
I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets.
By removing the link between gold and the US dollar, President Nixon created a system where all currencies were backed by nothing. This is what is known as a fiat currency.
Government-issued fiat currency is not backed by a precious metal such as gold or silver. Instead, it is designated by the issuing government as legal tender, meaning it must be accepted as a means of payment within the country. This type of currency is backed by the public's trust in the government. Since the end of the Bretton Woods system in 1971, most major currencies in the world are fiat money. Fiat currency has value because the individuals who use it agree on its value. They trust that it will be accepted by merchants and others as a means of payment for goods, services, and liabilities.
When the politicians say, well, we don't need anything of intrinsic value anymore, all we need is political decree. We can say this is money, this piece of paper is
The
money.
old system, if you ran a budget deficit, then what would happen is gold would flow out of your country until there was a balance again. Well, without any gold backing, then countries ran perpetual deficits. So if you look at, for example, this country, from 1971 on, the U.S. has never run a surplus. Ever since we went off the gold standard, it's just been perpetual stimulus. Good times, bad times, always run a deficit.
The government's balance sheet includes revenues from taxes, tariffs, service fees, and investments, and it incurs expenditures on healthcare, social security, education, defense, and infrastructure. The U.S. Treasury is essential in managing these finances. It collects revenue and disburses payments to support government operations. When expenditures exceed revenues and lead to deficits, the Treasury issues bonds to raise the necessary funds. When the U.S. Treasury needs to raise money, it issues government bonds through auctions. These bonds are not managed by the Federal Reserve. However, the Fed can purchase these bonds as part of its monetary policy operations. The primary buyers of these bonds include foreign central banks, financial institutions like those on Wall Street, pension funds, and individual investors who view these bonds as secure and low-risk investments because they are backed by the full faith and credit of the U.S. government. The government often runs budget deficits, meaning it spends more than it collects in revenue. To cover this shortfall, the government borrows money by issuing bonds. The accumulation of these deficits over time contributes to the national debt. To repay this debt, the government may issue new bonds to obtain the funds needed to pay off maturing ones, a process known as rolling over the debt. This cycle of borrowing and repayment is how the government manages its debt levels.
Monetary policy is when the Fed uses its power to create or destroy money, to lower or raise interest rates. If it creates more money in the system, money becomes more available and interest rates fall, so we're more likely to borrow and spend. If the Fed takes money out of the system, we borrow and spend less and are more likely to save.
If you're raising rates, you want to slow economic activity to cool inflation. When you lower rates, you want to stimulate some economic activity.
In the 1960s, President Johnson's Great Society program, combined with the massive escalation of the Vietnam War, significantly increased government spending and drove prices higher. Normally, to protect the dollar, the Federal Reserve would raise interest rates. However, Johnson was hesitant to take this step, as it could derail the Great Society initiatives or cause a recession. This reluctance contributed to government-induced inflation. Additionally, this period saw the biggest increase in the labor force due to the entry of the baby boomers. By the mid-60s, the massive baby boomer generation entered the workforce worldwide, causing a surge in the consumption of goods and services. This explosion in demand led to the significant price rises, inflation, and the largest demand shock ever seen, with the supply shortages unable to keep up. Oil prices, commodities, and everything else went through the roof.
And clinging to flawed economic theories, the Fed refused to raise rates. Over the next decade, the cost of living more than doubled, as the dollar lost more than half its value.
When I was appointed by Jimmy Carter, he was kind of up against it. It was a very difficult period. People don't like to raise interest rates. It's not very popular. And there was some resistance and fear of creating a recession and so forth.
Volcker had tried to get the Fed governors to nudge interest rates upward, without success. So he tried a different tack, persuading them to focus on controlling the money supply. It was a sleight of hand, because the two are essentially the same. But it was a politically palatable tactic, and it worked.
And when he slowed the money growth rate, predictably, the interest rate went way up.
Neither he nor I nor anyone else had any idea of how high the interest rate was going to be.
8% to 9% to 10%.
15% to 18, 19, 20%.
21%.
Really the highest levels in American history.
Paul Volcker was villainized for his inflation suppression.
Paul Volcker's interest rate hikes caused short-term pain but led to long-term gains. It was an unpopular move, but it's crucial that sometimes leaders make tough decisions.
With inflation tamed, Volcker was expendable, and President Reagan would not reappoint him to a third term. But Volcker had restored faith in the dollar and in our central bank. And he'd laid the foundation for an era of unprecedented prosperity. It would be up to the next chairman to keep it alive.
Under Greenspan's leadership, the economy generally performed well with a rising stock market. The end of the Cold War and the expansion of global trade further spurred economic growth and interest in market economies. From the early 1980s to the late 1990s, the stock market tripled in value, driven by falling interest rates and low inflation. However, this period was not without its challenges. The 1987 stock market crash, also known as Black Monday, was caused by a combination of factors and the increasing use of complex financial products like derivatives.
This has been the worst day ever in the history of the New York Stock Exchange. The Dow off more than 500 points. Paper losses more than $500 billion.
The fear in the market quickly spread, and so the Federal Reserve lowered rates very rapidly, provided liquidity very openly.
Alan Greenspan handled that event very successfully, reassured the markets, eased monetary policy.
You say, this is really good. This is why you want this monetary policy to be the way it is.
It was a historic moment, but it came with a dangerous precedent. From now on, the Fed would be expected to lower rates based not just on problems in the real economy, but in the stock market as well. What followed was the longest economic expansion and largest stock market boom in U.S. history.
Beneath the surface of Greenspan's actions, new unintended consequences were brewing, known as asset inflation.
Asset inflation. That is, prices not of goods going up, but of stocks, bonds, real estate, and other investment assets going up.
As stocks soared to record heights, he refused to use his power to cool overheated markets, would instead intervene aggressively at the first sign of weakness.
Greenspan's reluctance to regulate the markets and his tendency to intervene at the first sign of trouble encouraged riskier behavior among investors.
In Greenspan's reign, the financial sector would double its share of the economy. The Fed was offering the markets an amazing deal. No regulation to prevent you taking risk, but if your bets went wrong, lower interest rates to rescue you. U.S. stocks soon became more overvalued than at any other time in history.
The stock market bubble grew exponentially from the early 1990s, with companies forming without solid business plans and investors pouring money into new dot-com ventures, until the bubble finally collapsed in March 2000.
And he quickly responded with a series of interest rate cuts to soften the blow.
There was a big fear after 9/11 that we were headed for a huge recession. That didn't happen.
It looked like Greenspan had done it again, but there was a catch. The Fed had softened the dot-com crash with aggressive interest rate cuts, and now those same cuts set off another boom.
Lower interest rates meant lower mortgage payments, which created an unsustainable bubble in the housing market. With low rates and easy access to finance, people started investing heavily in real estate as a way to build future wealth. This borrowing spree wasn't limited to Main Street. Seduced by low interest rates, the world's biggest banks jumped at the opportunity to multiply their profits through massive borrowing, or as they say on Wall Street, with leverage. The Fed's monetary policy set interest rates at 1%, but banks lent out these funds as mortgages at 5 to 6%, and they issue loans even to people with poor credit histories, known as subprime borrowers. Banks assume housing prices would keep rising, allowing them to recover their money even if borrowers defaulted. Banks bundled these risky loans into complex financial products and sold them, spreading the risk throughout the financial system. Despite knowing a collapse was imminent, some institutions resold these subprime mortgages. When housing prices fell, widespread defaults occurred, causing mortgage-backed securities to lose value and leading to massive losses for banks and investors. This chain reaction triggered the subprime mortgage disaster and the global financial crisis of 2008.
The Fed had unique authority to regulate all mortgage lenders. It finally used it in 2008. They could have stopped the subprime unit of layman.
As Alan Greenspan's term drew to a close, his transformation of the American economy was complete. A financial sector of outsized proportions, housing bloated by borrowing, a dismantled regulatory system, and a collective delusion that all was well.
One of a president's most important appointments is chairman of the Federal Reserve.
My first priority will be to maintain continuity with the policies and policy strategies established during the Greenspan years.
As we wrap up part 2, it's clear that the post-World War II era, the economic shifts laid the groundwork for our current financial system. Now, these historical events are key to understanding why our economy and monetary system is facing such profound challenges today. Now, in part 3, we'll talk about money printing and the escalating debt bubble. We'll explore how they have strained the system and why some believe we are near breaking point. If today's insights have piqued your curiosity, you won't want to miss the next chapter. Join us as we uncover the forces driving the potential downfall of the fiat currency and the rise of new financial paradigms. Stay tuned.